Good afternoon and welcome again to Money Tips. Today I've got a very special guest to talk to you about his money and wealth advice. His name is Timothy Smith or Tim Smith. He is a CFP and the founder and CEO of Aurora Private Wealth Inc. He has 40 years experience in financial planning. He co-hosts the Financial Dad podcast, aiming to educate younger entrepreneurs, influencers, creatives on essential financial topics. He's based in Florida in the US. Tim is actually also working on a book offering advice on safeguarding investments against fraud, highlighting his commitment to ethical financial practices. Tim told me before we started that it's quite a big problem in the States. A lot of people lose money, not from scammers, but from actual financial advisors. I think it might be 30 million or 30 billion. And Tim's experience in public speaking and theatre enhances his ability to convey complex financial concepts in engaging and relatable manner. He's also a performer. He's a singer and has sung for 3 presidents, which is amazing. So he's got a very interesting life. So welcome, Tim. Great to meet you and lovely to see you on my podcast. Welcome.
Thank you very much, Charles. Very happy to be here. Thank you for having me.
Great. Well, we're in a period of the post-Trump tariff week where it shocked the world and we saw markets falling, and the newspaper was reading about pensions shrinking, market chaos, people worried about their pensions. You'd call them the 401ks, where they're all invested in maybe 80-90% in shares and stocks and equities, and they've seen the value of those fall. So interesting times with the markets having the worst day ever and then the best day ever. So
Yeah.
I don't know how you feel about that. What are you advising your clients to do in these times of turmoil?
Yeah, the first thing I advise them is to stay calm.
Yeah,
Don't get excited or be emotional about the whole thing. The second thing I typically remind them is that the manner in which we have invested their money takes this into account, this potential event, or frankly, any kind of black swan event, let's call it, right? Something unforeseen that jolts the markets and creates panic and creates a downturn, like
yeah,
COVID, for example, was
yeah,
very similar. And actually, COVID was very similar also in that it was a kind of unknown territory. And tariff wars are unknown territory to us because they really haven't existed for like 100 years since the Smoot-Hawley Tariff Act in the United States and, all of that. So, and by what I mean by I've positioned them for it is this: if someone is close to retirement or is in retirement, we typically would have them positioned so that there's a portion of their money that is in fixed income instruments and is either producing income for them to live on or is ready to produce income for
right,
them to live on. And the portion of their money that is in the stock market shouldn't be money that they're planning to need for anything for at least 5 years, typically at least 10 years or more. The third thing I remind them is for many of them, I have used certain kinds of instruments that tend to have downside protection to them so that a lot of this is a kerfuffle that doesn't really matter very much to them. And as to that second issue of, 5 to 10 year time windows, these sort of, again, black swan type events, they tend to be sharply down and then maybe not as sharply up, but they can tend to rebound pretty quickly. So just to use COVID again as an example, the US stock market fell about 37% in 3 or 4 weeks. It was hellacious, basically. And by the way, we've had nowhere near that kind of an event with the tariff war. And 6 months later, the market was back to where it had been prior to the COVID outbreak, and has moved higher since then, despite everything that happened with COVID and everything that we went through with COVID, all of the economic disruption, et cetera. So, I just remind them that they need to have a long-term perspective. I think having done this for 40 plus years, I tend to have a long-term perspective because I went through this in 1987. I went through it in 1999. I went through it in 2008. I went through it with COVID, and we're going through it again. And frankly, this one has been not so much a market event as it has been a media event, I'll call it. Trump is so divisive, so disliked by so many, and in particular in the media, that anything that he does that turns negative is sort of blown out of proportion, I would say. So the movements of the markets have not been as extensive as the media coverage of the movement of the markets.
True.
And so, essentially that's what I talk about. When I talk with clients, I am non-political, other than as it relates to history and how politics and geopolitics and markets and economies interact typically over time. So, that's basically what I've been telling people. And I don't have anybody who's wanted to pull out of the market or make changes of any significant nature, I would say.
Yeah, you're right about the media. I mean, for about a week, every day they were covering minute, oh, the market's fallen, it's opened in New York, it's fallen now. And you'd never hear that normally. The financial news is normally at the end of the news, and the Dow Jones is here, and that's it. But they were covering it minute by minute almost, and
Yeah.
talking about
Well,
market
and
falls.
there's two things I see about the media also. They like to use the word crash because it draws eyeballs right to
More
them.
dramatic. Yeah,
And we don't have a technical definition of crash, right? So,
yeah,
5% down day, is that a crash? Is that a mini crash? What is
correction
that?
or yeah.
And the I forgot my other point already, but that was the main point that I was going to make about how the media handles these things.
Yeah,
The other point was, in the United States, they always tend to focus on point changes per day. So 1,000 point change on the Dow Jones Industrial Average sounds immense, right? Until you look at it and go, it's actually 0.3%,
yeah,
because the Dow's at 36,000 or 35,000. So
true.
they don't talk in percentages. There's a thing that clients even struggle with when they have a lot of money. I lost $500,000 today in the markets. Yes, you lost 0.7% of your money today in the markets. You have a lot of money, so 1% movement is a lot of money. But I try to keep it for people in relative terms. And
Yeah,
when you do that with people, normally they can calm down a little bit and yeah, I know you're right. I know you're right.
yeah.
But it took a long time to make that $500,000. Yes, I know, but you do have you still have an awful lot left, right?
Yeah, and I like the way with your clients, you plan for their retirement. So leading into retirement, you start moving their money out of pure stocks and shares. Whereas a lot of people here have got these work-based pensions plans, which they don't have financial advisors working with them, so they just put their money in and forget about it. So
Mm.
I feel for them because they're not really seeing a financial planner on a regular basis to say, well, let's do something with your money here and there. A lot of them, of course,
We had a similar problem in the United States. People see the 401k as, okay, that's my long-term money, so I'm putting it all in stocks, and then I'll have some cash and stuff on the side or whatever. And they're not gradually planning as they approach a retirement age
yeah,
for how they should be divesting from the
yeah,
stock market to reduce risk, et cetera. And so that this event, I mean, if you were 6 months from retirement and you were counting on every dollar you had a month ago, in the stock market, that would just be imprudent, really. So as an advisor, if they walked into my office, I'd be saying, well, the first thing you need to do is take some risk off the table.
sure.
You're just too much in stocks for your age.
Yeah, yeah. Okay, great. So tell me about Aurora Private Wealth. I mean, how long have you been going, or what do you really
Yeah,
specialize in?
sure. By way of background, I started as a financial planner with a company in northern New Jersey in the U.S. and worked there 10 years. I felt the business was moving to more fee-based asset management
Right.
from traditional brokerage or transactional
Yeah,
business. And I didn't, transactional business didn't suit me well either. Transactional business is more of a kill what you eat type of a business from my perspective. And I'm a relationship guy, long-term
right,
relationships. So
right.
I like working with people, day in and day out over a long period of time. So I started my own investment advisory firm in 1995, and a couple years later, I was approached by some guys who wanted to join me from my old company, but they needed a broker dealer arm to make it work for them. So I started a broker dealer. That company became, a pretty large company with an awful lot of advisors around the country, all grown by word of mouth and referrals. So Aurora today is an RIA, an investment advisory arm, as well as a broker dealer arm and a fixed insurance arm. We're in
So
about
can I ask,
35.
what's the difference between those, broker, dealer? What are the difference between the three arms there?
Yeah, sure. So fixed insurance would be something like a whole life policy or
Right,
a fixed indexed annuity, or a disability insurance policy.
right.
Investment advisory would be something like you have $500,000. We're going to charge you 1% per year, $5,000. And we are going to pick and select securities under discretionary powers. And we're just going to manage the money. Think of it as money managers,
Right.
basically. The brokerage side is historically the traditional transaction based um, side of the financial world. So stocks and bonds, where you make $100 for buying Apple for somebody or whatever. But in our context, it's used primarily for instruments such as variable annuities, which
Okay.
is a tax-deferred shell surrounding what are called sub-accounts that look like mutual funds. So you can put money in it and you defer the capital gains and dividends and interest out into the future,
Okay.
but while investing in what is conceptually similar to mutual funds. So that and also what we call alternatives, which might be a real estate investment of some kind and that kind of thing. So those things have typical commissions, although the vast majority of the revenue in my broker dealer actually is what are called trails. That means it's very similar to the concept of investment advisory. We get a percentage of assets for helping the client to service that and to make decisions long term on the underlying investments, but it's not done with discretion. We don't have the ability to go in and change the underlying holdings and things like that on based upon our own discretion. So think of it as transactional slash commissionable, primarily
Right.
money management or insurance products that really aren't securities primarily.
Okay. Okay. And your clients are they across the board sort of people or high net worth people or
They tend to be what we call mass affluent to high net worth, a few ultra high net worth. Our largest account as a firm is about $510 million.
wow.
We have 50 or 60 offices in like 35 states. Um, Billions in total under management.
Amazing.
So, it's a nice business. It's been a nice ride, I would say, for
Fantastic.
30 years.
You've done very well. So it sounds like you've been through all the turmoils of the 80s and the 87 crashes and different market movements, the 2008. I mean, even in the 90s, things were a bit choppy at that time. So you've been through a lot of things and survived it and built your business. So well done.
Somehow I'm still standing.
Well, that's
You know what?
great.
I have a terrific team. I have some terrific partners who are a family office that invested with me 20 years ago. Um, I'm really very fortunate and very blessed.
Okay, great. And you've also got a podcast, the Financial Dad podcast. Uh, Tell me about that because that sounds interesting. I like the name, the Financial Dad.
Yeah, yeah. So about 7 or 8 years ago, I have a son, and he was graduating from college with a degree in computer science, and he and all his friends were headed off to companies like Apple and Google and the Department of Defense for cybersecurity and all this stuff. And he said to me, "Hey, Dad, would you mind coming in and giving a little seminar on personal finance for me and my friends? Because, we just finished college and nobody gave us any idea about all this stuff, company benefits stuff, and what's a 401k and how to invest for the long term, how to get a house, how to get a car. And so I went in for 3 hours, and it was actually about a month before they graduated. I went in for 3 hours, and there were like 15 kids in my son's apartment, which was not big enough, for 15 kids, but there they were. And I spent 3 hours with them, and I, answered questions and just went through all this stuff. We actually recorded the whole thing. And, then so one of my daughters says to me afterwards, Dad, you should really do this for young people because nobody's teaching us this.
Yeah.
We don't
Yeah.
get it in college. There's very little in college. About 20 US states do require something in high school, but to be honest, it's very elementary, and a lot of the kids don't even remember what they heard, including my own daughter, who said afterwards, "Oh, is that what that was supposed to be?" You know?
Yeah.
So then we started doing videos on financial topics with one of my daughters, who's an actress, and I have another daughter who's a PR person. So the team of us has really been very, very, very good. I just sit and I talk, and I'm able to go off the top of my head because I've been doing this for so long. And my daughters ask, they pound me with questions. They don't understand this. They don't understand that. I have an outline typically. So we do videos, which are available on the Financial Dad site. In fact, we're releasing like one a day for the next 10 days still, or something like that. Then we've been doing, they've interviewed me for some of the podcast episodes specifically. And then we have interviewed entrepreneurs for some of the podcast things as well. And ranging from people who are just business owners that are fairly successful to people with, net worths in the hundreds of millions. So it's really a very broad-based thing. There's a lot of it is advice, and here's what I would tell my 25 or 30-year-old self if I could do it over. These are sort of the basics of what's required: the discipline, the mindset, for a business owner or an entrepreneur or someone who's trying to make a go of it on their own in something, as I have. And there's something like 30 million small businesses in the United States. So there are a lot of people who, especially the younger folks, who can benefit from uh, learning about these topics.
Yeah.
Most people who start a business don't go to business school and then find a business that they think they can make money in. Most of them get a career and they realize they think they can do something better than what's being done today in their field of specialty with no business background. So
Yeah.
the Financial Dad is targeted at providing educational information. It's all on YouTube.
Okay.
It's at the Financial Dad. So, you can go find us and watch away to your heart's content for free.
Fantastic. So, but I think for the young people, they don't learn this stuff in school, and a lot of
Yes.
young people are now leaving college, university with huge debt around their neck. So, it's tough, especially if they don't know what this is and what these employee benefits are and what that is. Yeah, it's a great thing that you're targeting that young audience, and yeah.
Yeah. And, we talk about debt. We talk about credit cards, for example, how to
Uh,
avoid the credit card trap of high interest debt and everything else. Even with the debts that they have from school, sometimes they wouldn't think of it in terms of I have one loan at 5% from when I first got into college, and I have another loan at 8% later in college when interest rates had risen. I should pay off the 8% loan first. Just simple concepts like that. They have
yeah.
no schooling in, so they might be paying, equally or proportionately to each, rather than saying I'm going to pay the minimum on this one and I'm going to fuel as much as I can to this one to try to get it done faster. So things like that. Unfortunately, I mean, there are debt counseling services and things like that, but a lot of people don't want to go to a debt counselor just out of embarrassment and time and everything else. So go to the Financial Dad and find it there.
Yeah, because I read that defaults and arrears on credit cards and loans are starting to rise as people are
Yeah.
feeling the pinch. So it is a big
Yes.
problem here as well. We tend to be a country like the States that uses cards a lot. There's, everything's on credit, and cars and credit cards, sometimes charging late 20s, 28, 29% interest. When
Yes.
we're in a low interest environment, but the banks are still charging this huge margin on credit cards. It's always been around
Yes.
20%.
It
So
is. It is an immense moneymaker. When you explain to a kid, banks are borrowing money at 6% and they're loaning it to you, and if you keep it outstanding, it's at 29%. And even quite frankly, you know, the 3% that they make upfront, 3 to 4, I think in the case of American Express, it's upwards of 4%. If you think about that, you buy something today, they get a 3% discount in what they pay to the supplier or vendor, the company you bought from, and you pay them in a month. Even with that, they made 3% for the month, so
That's
they're
true.
making
Yeah.
36% on average if people pay off on time. And if you pay off earlier than a month, it's even better,
I
right?
think this is why.
So,
Yeah, go on.
it's a good business model. good good work if you can get it, right? Nice
Sure,
work
I
if
think
you
this
can get
is
it.
why Warren Buffett said, borrowing money at 20% to buy consumer goods is dumb. And that's why he owns credit card companies. I think he owns a portion of American Express. It's been one of his favorite stocks because it probably
Yeah,
makes him so much money. But you say
yeah,
the banks will borrow money at 6%. Actually, if I put my money in the bank, they're borrowing from me because I'm effectively loaning the money. It's not really my
yes,
money anymore. They own the money. And they're
yes,
borrowing it, they're giving me sometimes 2 or 3% on the money. If I can
yes.
get a better rate from HSB shares by buying the shares, they pay me something like 8% dividend that I
Dividend,
put in the
yeah,
bank account where I'll get 2 or 3. They're not really interested in raising the interest. They've got enough money in their coffers to not bother raising interest rates to competitive rates. I mean, you can
yeah,
get better rates with challenger banks and smaller banks, but the high
yeah.
street banks here don't pay very much. So they're making huge margins on the money they're lending out.
Yeah. I mean, obviously they have to deduct from that their expenses and then their defaults, the money they lose on theft,
Yeah,
the money
true.
they lose on people that don't pay. But I got a feeling it's not 20% of the revenue,
No, no,
you know?
that's true. That's true. So, what do you generally advise young people starting out then to do? It's starting out in their life, maybe it's their first job. What do you? I mean, obviously things like look at your pensions and look at your insurances. What's your general advice for them?
Yeah, so one of the things that I try to impress upon young people is that, look around at people who are older than you, who have built up savings, wealth, that kind of thing. The way that they did not do that was by having, a salary of $40,000, take home pay of $30,000, and expenses of $50,000. Okay. So the key to long-term wealth building is that you have to live well within your means. Whatever you're earning, you know, if you're living on a day-to-day paycheck and you're not saving money, that cycle can't continue till you're 65 unless you just want to go on government, Social Security, in our place, the UK pension scheme. Uh, you know, you have to break that cycle eventually if you're going to try to build wealth. So I tell people right out of college, if you save 10% of your salary every year, and if on top of that you're with a company that gives you 3%, 4%, 5% on top of that, you will be able to retire early. Live within your means. Don't build up debt. You'll be able to retire early.
Let's say that
If
again. If
you,
you save
yeah,
10% of your salary and the employer's
yeah,
putting in what 3% into your pension, for instance, your
yeah.
401.
So in the United States, the 401k plan, as you mentioned earlier, typically there was what we call a company match.
Yeah, same here. Yeah. Yeah.
So companies no longer have pensions where
Yeah.
they
Defined
guarantee a
benefit.
lifetime
Yeah.
income for people who have worked for them for a long time. Instead of putting away a whole bunch of money, now all they do is they put away 3% of your salary if you put away at least typically 3 to 5% of your salary,
Right.
something like
Right.
that. So the vast majority, certainly large employers, virtually all do this, and a lot of small employers also
Yeah.
do it. So you're getting 10% plus 3%, and by the way, you're making 30% on your 10% in your first year because you made the contribution. Um, and the math of that, and I've done a whole bunch of long-term projections for people. When you look at the living standard that the person would have if they're saving 10% and what would be left, and you project that out for them until they're 60 years old, they virtually always have enough money saved to be able to be financially independent. And that assumes a number of things, but that their living standard remains roughly equal to their salary as their salary grows, um, and that they earn, 8% long term on their money in the stock market, 6% in retirement, let's say. Um, so, 2.5% inflation or something like that. So there's a lot of assumptions to that. But
Yeah.
generally speaking, people will be able to retire if they just follow, that one simple thing.
Yeah.
If they don't have a company match, put away 12% instead of 10%. But, so that's number one. Number two, you have to think about things now like, does your company offer health insurance? Does your company offer disability insurance? Disability is far bigger problem for young people than the fear of death, especially if you're single. If you're single and you have no one relying on you, life insurance is not that important.
Right.
But disability insurance, I think the number is you're about 5 to 6 times more likely to become disabled till 65 as a young person
Really.
than you are to die. So making sure you have disability insurance, and typically employers in the U.S. provide this, but making sure you have disability insurance is really a key factor in overall financial planning. The avoidance of debt, living within your means. I counsel young people about how eventually you're going to be able to buy a house. So short-term goals, having some money set aside for an emergency, starting to set aside money towards a home purchase. There are really three really big things that people in the United States have to prepare for financially: a down payment on a house, sending kids to college, and retirement. Virtually everything that I talk to people about as long-term issues falls into one of those categories, right?
Yeah, it's a good point.
So,
Yeah.
those are the biggies. So how am I going to get enough money for a down payment on a house? Will I get help from family? Will I get help from the federal government because I'm a veteran? Am I going to have to save it myself? And in what time period will I be able to save how much money, and what kind of a down payment will that get me, and what kind of a house will that get me? Right. So
Really, you need to save
helping
more
them
than
in,
just 10% for your long. You need to save more than 10% then really of your income.
yeah, yeah.
You're
You
also
know
going
what?
to save for a house. Yeah.
It's funny you say that, because when we had kids, when our kids were young, we we gave them an allowance, and we told them to take 1/3 of it and spend it, 1/3 of it and save it, and 1/3 of it and give it to charity. The idea of the charity part was that either A, they'd become charitable, or B, they'd get used to giving money to the government. So either way, they weren't going to get that money eventually.
Yeah. Yeah.
So the notion that, every dollar you get, you can't expect that to be spent.
Right.
This is gross, this is net, this is spendable, this is savings. Um,
Right.
Trying to get them to think in those terms from a young age, I think, is really valuable for families and young kids. And because when you get into life, that's pretty much what it comes down to. There's going to be a chunk that goes to taxes. There's going to be a chunk that should be going to savings. And when you're trying to prepare for retirement, to buy a house, and then hopefully when you get the house, now it's kids. So it doesn't end with the buying of the house. You get kids, now you can just try to start to save money towards their future, higher end education. Um, it's just a better way of thinking, as opposed to, oh, I got $1, I'm going to spend $1.
Let's go blow it. Let's go out for the weekend
uh,
and blow it. If we can't afford it,
Gambling,
we'll put it
Las
on the credit
Vegas.
card if we can't afford it.
Right. Yeah. Let's use our credit cards to get a balance for Atlantic City. Right.
You're right. I think you could look at it another way, living on a percentage of your income, not living on 100% of your income, but living on 90 or 80 or 70%. You live on that, and the rest is saved or invested for your future, whether it be buying the house or your kids' education or your retirement. But
Yeah.
you're right to
When
get them
you
into that
if,
mindset.
if you talk to kids in college, maybe third year in college, when they're starting to think, okay, maybe I'm going to get this kind of a job. They're starting to learn what kind of entry level salaries may exist for that kind of a job. And, so they say, oh man, I'm going to be making $40,000 a year, $50,000 a year. I am going to be cranking with money, because they've never had that kind of money.
Sure, that's right. Yeah.
They're making $15 an hour, and even that they're surprised if they have to pay FICA, Social Security taxes on it. It's like, wait, I didn't get $15 an hour. What? Welcome to the world of adulting. Um, so starting to get them thinking, okay, no, it's not going to be $50,000 I can spend. 10's going to go to taxes of one kind or another, generally speaking. I'm going to try to save at least five. I want to save another five, start to get money towards a down payment. So I'm really going to have something more like thirty to $35,000 maybe to live on. I'm going to need to live on $2,500 a month or $3,000 a month. So, okay, what can I rent as an apartment for that? I'm going to have a roommate for that kind of money. They start to at least plan in their
Yeah.
heads properly and realistically, to be honest. So it's not this immense shock to them when they get to that point where they're thinking, oh yeah, I'm going to be spending over $4,000 a month on booze and gambling or sports or betting or whatever.
And the rest I
Um,
squander.
yeah, yeah.
Yeah. Yeah.
They get a
That's
more
good.
realistic picture of what it's going to be like, and honestly start to develop the right habits early.
Good. I like that. I like that. I think we've probably gone for like 40 minutes or so now. I
Wow,
think
feels like we've been talking for a minute.
I know it's amazing. But so your basic rules for people are simple. Live on a percentage of your income, or if you can save 10%, if you can save 10% of your income throughout life and you keep it at 10%, you can retire early. But then you've also got to plan for saving for a down payment on a house and then college education for your kids, which I know is very expensive in America.
Yeah,
And then look at the insurance side of things, the disability and
yeah. And then obviously, as a 23-year-old to say you got to go get a will, it's kind of a hard case to make. But so I have a daughter who just had a baby, and they came to me and said, Dad, we need to plan our life insurance. We need to get wills, et cetera, et cetera. And wills are a little more complicated than they seem once you have a child because you typically will want something called a contingent trust built into both wills. In the event that both parents die, you want to name a trust to take care of the assets and the college funding for the kid and all that kind of thing, or kids.
yeah,
So it's not the kind of thing that you can sort of go on to, an online legal service and just say, oops, I want that. There's more to it. So as people go through different stages, it becomes more complicated and they need more advice, more hand holding. Um, but so yeah, you got to get a will eventually, in addition to your life insurance and your disability insurance and your health insurance, your car insurance, your home insurance, by the way, for me, insurance is for necessities, not luxuries. So, I don't typically recommend insurance for people who don't need insurance of one kind or another. For example, wealthy people, if they want to buy long-term care insurance to protect against the costs of a nursing home, let's say, I'll sometimes point out to them the nursing home is going to cost $150,000 a year. Your income from your investments is $270,000 a year. So if you go into a long-term care facility or something like that, you'll probably be spending less money than you're spending today. So do you want to buy the insurance? Sure, go ahead, but it's not a financial necessity. So I try to, um, if I were paid a commission on the long-term care insurance, I would have a motivation to sell it to them whether they need it or not, right?
correct.
So,
Yeah.
I think that's where a fee-based advisor, which is 99% of what I do, comes into play because we don't have the same conflicts.
Yeah, I get that. Yeah, so they're selling products and going back to the office and saying, "Yeah, I made another sale today, and I'm in the $1 million round table and this sort of stuff." And they're selling products, and you're doing a different thing. You're acting in an advisory capacity
Yes,
and
exactly.
a wider range of things. So I like that. So um, is that the type of advisor people should look for? What would be the category of your advisory?
Yeah, well, there are benefits obviously to those products, right? So I would never say don't ever talk to someone who's paid on a commission basis. Quite frankly, in the insurance side of the business in particular, everything is basically paid on a commission basis. So um, I think though that getting some honest advice from someone who has no skin in the game, but who is knowledgeable, who is an expert, I think is a very, very useful thing for people to do. So, for example, I did this insurance analysis for my daughter and son-in-law, and I recommended an insurance advisor to them that I know personally, who's a fantastic guy. I told him what my findings were, and he said, "Yeah, I'll write them for that." And they know that they're getting an honest, unbiased opinion as to what their needs are, and the insurance guy is online with that. And there you go.
Great, great. So how do people find your company? How do they look you up? I know there's the Financial Dad in YouTube, but do you,
Yeah, so Aurora, my company is Aurora PW, P as in Peter, W, for Aurora Private Wealth, aurorapw.com. That's our website address.
okay,
And the Financial Dad, again, at the Financial Dad, one word effectively. And on YouTube, you'll find our stuff there. And we're adding more stuff all the time. Tomorrow afternoon, I've got a 2 hour time set aside to do exactly what I'm doing with you today,
great.
except I'll be asking the questions instead of answering the questions.
Yeah, yeah,
Actually, no, tomorrow I'll be answering questions. I, I have to
great.
try to keep it straight in your head what you're doing from one day to the next, right? So yeah, I mean, those are the two primary things. And people can reach me. My email is just Tim, at aurorapw.com if they got a question or an issue or they want, somebody to give a second opinion or something like that.
Okay, great. Well, I'll put some links up to your sites and that sort of your website and your YouTube channel. So I'll do that. I'll put it in the notes on. This will be going out on YouTube, and we're also out on Spotify and Apple Podcasts as well, and a few others. So we do
Great. Oh
video.
yeah, we are too. Just yeah.
Yeah. So great. Well, it's fantastic meeting you, and I think I like the way you've narrowed it down to three separate areas and given some good tips for young people, and not just young people, anybody that's perhaps floundering around and not. I mean, there are a lot of people here in their 30s still living at home with dad and mum and dad and spending their money and going backpacking around the world all the time and haven't even started. They're just
Yeah.
a lot of
Well,
people
there's a little
motivated.
bit of a different problem there, Charles. Um, Motivation and
Yeah.
a desire for to have a career and a direction in life and a reason for being, right? Um, that can be lacking, and no
Yes.
financial advisor can instill that in someone, of course.
True.
But yeah, I, I do see it. One of the most interesting clients I ever worked with was 35 years ago making $500,000 a year, which is probably the equivalent of like $2 million a year today, and spending $800,000 a year, the equivalent of $3 million a year today.
Wow.
And they wanted to know how they could get on a better financial footing. And, the answers were the same.
Yeah.
Live within your means. Stop. You have to reduce your spending so that you can start to reduce your debt so that you can eventually start to save. I mean, it's just, there's no real, the concepts are very simple, right? The concepts of finance are very simple. The minutia of it has a lot of nuances and complications, but the concepts are pretty darn simple. And the vast majority of people, I would see people who had bought a second home when they were 50. You know, how do you think they did that? They saved. They saved their money. They built home equity.
Yeah.
They got their income up high enough that they could support two mortgages instead of one. They lived within their means. I was motivated to go into this industry because my parents knew nothing about personal finance. And growing up, the arguments I always heard were always about money.
Yes,
And,
the same.
I think that just drove me to understand money and to help other people with money. And, I didn't want my kids to live in that sort of same environment of, we found other things to fight about, of course, but, we, uh, I didn't want that to be the thing, that they grew up remembering. And so I've had a very, very fulfilling career, met and worked with some absolutely wonderful people. I don't work well with people if they're not wonderful people. Um, Fortunately, I can say no to someone
Right.
and not take them on as a client or as somebody I can give advice to of some kind. So, um, it's uh, I'm just a deep believer in helping other people and giving back. And it's really nice to be at this point in my life where I'm able to do that. I have the time, I have the knowledge, the experience, the resources. It's a great spot to be in.
Good. And I think your channel, the Financial Dad channel, is also giving back, isn't it? You're giving free advice to people. You're helping and inspiring people. So that's another way of giving back, isn't it?
Yes, sir. Yes, it is.
Yeah. 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 Great. Well, it's been fantastic meeting you. I think a lot of your experience is similar to mine with the parents and that sort of thing. So yeah, it's been really good to meet you, Tim, and I hope
You too, Charles.
we'll chat again. And I will be directing people towards your website and channels.
Great. Thank you very, very much for the time and for the exposure. We really appreciate it.
No problem. Anytime, Tim. I'd love to talk to you again. Thanks very much.
So would I. Thank you, Charles. Be well.
Thanks.